All right, so welcome back. So this is our last official week of the course. It's week 3. Sad. However, there will be a bonus week next week. And there's going to be a bonus week with Jesse Walden talking about crypto, intersection of crypto and creators. And then with Nathan Barry about building ConvertKit and serving the creator space for the last decade, basically. And the topic of this workshop is sharing my investor perspective as an investor in the creator economy. And I built this into the course because something like 65% of all of the students in this course are early stage founders. And when I was looking through applications, a common question that came up was, I want to better understand what investors are looking for. I want to better understand how I can raise money from investors. So my goals for today are to equip you with an understanding of what investors are looking for, and to, if you're an investor in the space or looking to angel invest, sharing what I'm looking for when I'm looking at deals so that perhaps you can learn from that. I want to caveat all of this by saying upfront that there's basically an infinite number of criteria that investors could look at. And this presentation is really based on my own personal perspective. All investors have their own individual frameworks on how they make decisions. So this is not a definitive or exhaustive checklist. I should really be titling this session My Investor Perspective because I don't want to speak for everyone else. And because investors are all different, for the last about 40 minutes of this session, I'm going to be pulling in Blake Robbins from Ludlow Ventures, who is also an active investor in the creator economy, and doing a casual AMA and fireside with him. And by the way, before we get started, just in case you guys have been living under a rock and missed the news, I have a fund now, so I'm actively investing in this space. So if you're a founder, please pitch me. I would love to invest in you guys. Just DM me on Slack. Cool. Let's dive in. So for context, I've been full-time as a venture investor for the last 4.5 years. And for early stage investing, you won't actually know the outcome of a lot of these decisions for 5 to 10 years. So I still feel like I'm learning in terms of what goes into making a good decision and making a good investment. But over this period of 4.5 years, I've seen thousands. Can you guys mute yourselves? Over this time period, I've seen thousands of pitches, invested in probably 40 companies at this point, and have lots of early indicators on what correlates with success. And for background, from 2016 through 2020, I was a multi-stage consumer investor at Andreessen Horowitz, investing in companies all the way from idea stage, pre-seed, just founder with a pitch deck, all the way through growth stage rounds, pre-IPO, like unicorn valuation companies. So my experience really spans the whole gamut of every single stage possible. And my biggest takeaway from that experience was that the motion for early stage investing versus later stage investing is really different. On the early stage side, it's really more art than science. It's really about investing in the people and the team and the market. And then at the later stages, it becomes a lot more quantitative with an emphasis on metrics, benchmarks, growth rates, valuation comps, revenue quality, all of that good stuff. Today, I'm going to be talking more about the early stage side of investing, since that is what I love and what I do full time today. And that's also what's more applicable to the founders in this room. So I wanted to start with my overarching investing criteria across consumer in general. So this isn't specific to the creator economy. This is just how I think about investing in software at a high level. And this investing criteria is really similar to the investing criteria that we used at A16Z that would guide our decision-making processes. I wanted to first level set here on what investors are looking for in general at a high level, because I think this is just a good basis point to start off with. And so regardless of category of company, these were the elements that we were looking for. We were looking for a strong founding team. So in other words, like, do they spike in some areas? Do they have a bias towards execution and action? Do they have good go-to-market instincts, good product instincts, good storytelling ability to be able to hire talent and draw people to them? We were looking for companies that could be potentially massive, because that's just how the VC fund model works. Like, every company needs to have the potential to be a multi-billion-dollar business if you're investing out of a fund and need to return multiples of that fund. there needs to be some thesis on defensibility and a moat to the business. Like it couldn't just be easily copyable by someone else. Ideally, strong growth, and ideally organic growth in particular. And lastly, a clear path to monetization. This is a slide that I ripped from Elad Gil, who is also a prolific angel investor, on the hierarchy of investor interest. And this is good just to keep in the back of your minds as you guys are building companies, that investors do have different interest levels depending on kind of like the dynamics at play for the business. So the deals that investors are going to be most excited about are the ones with clear customer traction and compounding growth, i.e. there's clear proof points that it's working. It's not just a theory or an idea. It's really been proven out. And then from there, it's like, the next stage, the next level of investor interest would be hot market or well-known founder. Luckily for you guys, the creator economy is really hot right now. So most of you guys are at least at this level. Then it goes to like strong team with prototype all the way down to like lesser team with an idea. So the more proven something is, the more proof points that you can show that, this is going to be a real thing and that there's going to be growth and product market fit, the better off you guys are in terms of being able to incite investor interest. Moving beyond that high level investing criteria, I wanted to share five distilled criteria that I look at when looking at creator economy deals specifically. And that includes founder market fit, markets that appear small but are actually big, a product that delivers high value to its target users, growing with customers, and revenue expansion. So this is, as I said, not comprehensive, but I've basically distilled the key things that I'm looking for when I look at deals into this list of 5 criteria. So let's go through each of these. Starting with founder market fit. So previously in this course, we've talked about creator market fit, business model fit. This is yet another fit, founder market fit. So who can propose their definition of what founder market fit is in the chat? Let me see. I actually realized I don't know how to open the chat right now. Okay, Rachel, I can't open my chat window. So if anyone has, has left something in the chat, let me know.
Well, let's go with Felipe and Ichandi, who was the first to chime in.
Yeah, I would say a founder with an earned secret or a unique insight based on life experience or luck or some sort of circumstance that makes you uniquely qualified to resolve a problem.
Yep, right, like a unique insight or a secret. Okay, I found my chat window, by the way, so we're all good. I'm seeing, okay, unfair advantage, lots of experience and insights, the right background experience, founder solving their own pain point, all really great definitions. So basically there is no like one conclusive definition of this term. And when I looked it up online, there were lots of different definitions. There was a Business Insider article who said that it was, a founder who personified their product, business, and ultimately their company. There was a Forbes article that said founder market fit is this innate unfair advantage that sets founders apart from their competitors. That all makes sense, but I think the clearest distillation that I've seen of founder market fit came from this blog post by NFX, which is an early stage venture fund that unpacked founder market fit into 4 different dimensions. And those dimensions are obsession, founder story, personality, and experience. So what does that mean? So in terms of obsession, are they passionate and tireless about the idea? Are they obsessive in going deep into the market, knowing everything that there is to know about every attempt there was to build something in this space? On founder story, I think founder story can really be summarized with the word authenticity. Like, is there an authenticity to why the founder is building in the space? Why are they choosing to build something in the creator space? Was it just like a business school MBA type analysis where they thought creators was a fast growing space and so they decided to build something in there? Or is there a deeper level of authenticity there? Personality is the next dimension. Personality, I think, matters a lot in the creator space because the first few creators typically come on as a result of relationships, personal relationships. This was true of Substack, Cameo, Patreon, Stir, and a bunch of other companies in the creator economy, where their first few creators started using the product because of the founders' relationships. And so personality is really important when serving creators because it determines whether you're able to make the relevant connections that you need in the industry. And then lastly is experience. How intellectually deep are they in the domain? Did they take the time to learn the history, present, and have a theory on the future of the space? I think that this is really a sign of intellectual rigor if they're willing to go really deep and challenge all of their beliefs and take input from different sources. Now that I've sort of proposed this definition from NFX about founder market fit, I'm curious if you guys can think of any founders that really embody these traits who are building in the creator economy today. Okay, Jack is winning this one. That was who came to mind for me. Goggin and Wells. Yes, I totally agree. Kevin Lynn at Twitch. All of you guys, of course, I'm sure have great founder market fit. Mr. Beast, totally. Like every creator founder has creator market fit, or at least the authenticity element of it. Stephen Galanis, I totally agree. So yeah, the folks who came to mind for me were Jack Conti from Patreon. So Jack really built Patreon based on his own needs as a musician who couldn't make ends meet from the ad revenue that he earned from Patreon. And then the second example that I could think of is of an early stage company called Fan House, where they're building an OnlyFans competitor. And one of the co-founders, her name is Jasmine. Yes, Jasmine Rice Girl. And she was formerly a top 0.03% OnlyFans creator. And she built Fan House really for herself because she was really frustrated with all of the experiences that she had on the platform. In general, here are some other traits that investors are looking for among all startup founders. I love the phrase relentlessly resourceful from Paul Graham. He said, if make something people want is the destination, then how you get there is being relentlessly resourceful. So relentless is like plowing through challenges, perseverance, and grit. Resourcefulness is obviously like trying new things, coming up with new ideas. And another way to describe this, I think, is what Hunter Walk told me, which is a combination of aptitude and attitude. So on the attitude side, do the founders have a willingness to endure discomfort? There's an element of perseverance and passion. They have to be convincing and persuasive. Plus, they have to have the raw aptitude to actually do the thing. So these are just some of the attributes that investors are looking for when they're talking to your team. And obviously some of these things are really hard to assess for in especially a short meeting. A lot of times I'll ask for like childhood story, like tell me about, all of the things that happened to you that led you to building this company, like start from the very beginning. We would always tell founders at E16C, like start from the beginning. And the founders would start by talking about like their last job. And we would be like, no, like start from your childhood. Like, where are you from? Where were you born? Because we were listening for, have they overcome challenges before? Have they had to persevere through something? Do they have a history of excellence? The second thing that I look for is markets that initially might be dismissed as too small, but are actually bigger than they appear. So I think calculating TAM for creator stuff is pretty pointless, and I'll talk about why. So what do these companies have in common? Substack, Stitch Fix, Uber, Patreon, and TikTok. Does anyone want to propose? Okay, yes, you got it. It's kind of obvious from the title of the section. But these markets were initially, at the time that these companies got started, thought to be quite small, and then they actually expanded the size of these markets. So initially, you would have dismissed black cars as being a pretty small market. Personal styling definitely seemed like a really small niche luxury market. But each of these companies made it easier to both offer a product or a service on the supply side, and then on the consumer side, made it easier to access or afford something, thereby making the markets actually a lot bigger than they had been before. So the theme among all of these companies was there was latent demand on the consumer side. There was a large pool of customers who wanted something but just couldn't access or afford it before. And then on the supply side, there was also latent supply of folks who wanted to monetize or produce a certain thing, but didn't previously have easy to use tools in order to become a productive supplier in that market. So for instance, for Stitch Fix, in 2019, Stitch Fix's company revenue was $1.7 billion. I can guarantee that that $1.7 billion is probably larger than the old market for in real life personal styling as a whole in the US. And they did that by making it much easier to become a stylist, and by being able to serve many more customers than a stylist would have been able to without Stitch Fix's algorithms. And then on the consumer side, they drastically brought down the price point of personal styling, and charged something like $20 for the personal styling service, which is much cheaper than personal styling used to be. And you can go through each of these companies and sort of draw out those similar parallels among all of them, where they unlocked latent supply, and then that latent supply was able to offer a product or service at a lower price point, and made something much more accessible to customers. So that's essentially the textbook definition of disruptive innovation. Disruptive innovation, per the Clay Christensen definition, is companies that are targeting underserved or overserved consumers. And I extend that in the consumer space to not just targeting underserved or overserved consumers, but actually competing against non-production on the supply side. So creators are folks who previously had not created anything and were not producing anything, but by giving them tools and platforms that make creation easier, you're actually converting non-producers into producers. And the passion economy, the creator economy, is an example of non-producers becoming producers, and that in turn leads to more products and services that are available in the market, which leads non-consumers previously to become consumers. And an important insight from Clay Christensen's first book about disruption is that the TAM of disruptive innovations is unknown and it's unknowable. So the TAM of the creator economy is unknown and unknowable. The potential market for non-consumers always exceeds what is already being consumed. This is why I think in the first workshop, it was so hard to quantify, like, what is the TAM of the creator space? Well, with new platforms and new technologies and platform shifts and societal shifts, there's actually new creators being birthed every moment that didn't used to exist before. And so if you just looked at like the current market size of creators, that's going to be wildly underestimating how many creators are going to come about in the future if you were to build better tools for them. An example of this is cohort-based courses. So cohort-based courses are an example of a disruptive innovation because on the supply side, they're converting non-producers to producers in the form of experts who previously had a lot of expertise in their heads, but just hadn't packaged it up into a course. And that in turn is converting non-consumers to consumers on the student side. Before this course existed, you could maybe try to learn this content from piecemeal blogs, podcasts, etc. But a lot of this content just hadn't seen the light of day before. It hadn't been extracted from my head. And that's true of a lot of cohort-based courses out there. So if you were just to try and comp CBCs to continuing education spend or how much adults spend on like extracurricular education, that would actually underestimate the disruptive potential of cohort-based courses in online education, because to date, it hasn't been very easy for an expert to create a course and to teach it in a compelling way to students. All right, who remembers this moment? Show of hands. This was Clubhouse's Series A last spring. When the Clubhouse Series A was done last spring, it was still on test flight. It was mostly VC early adopters, and the $100 million valuation was widely ridiculed. If I don't know if you guys can see some of the text on here, but there's quotes calling it a, quote, absolute joke, place for VCs to voice memo each other in private. Only rich folks use it. But what these folks didn't recognize was that VCs are actually a novel wedge into a large market, and that larger opportunity was for social audio in general. And social audio was actually much larger than it appeared. And VCs are a great initial creator base for an audio product because VCs are inherently curious, they're very social, they love to share ideas, they have a face for Clubhouse, I like to say. And now Clubhouse has over 2 million weekly active users, and VCs comprise a very small percentage of that. So the initial wedge of VCs belied how large the market actually was for a new social audio product. The third thing that I look at is how much depth is there to the product and how much value does it deliver to its users. Here's a quote that showcases what deep product value can look like. This is an example from Shopify's investor letter a few years ago. They said, quote, Shopify is the first thing our merchants log into in the morning and the last thing they log out of in the evening. It's at the heart of their business. So in other words, it's a product that encompasses a really large surface area for their merchants' lives and is totally integral and critical to their customers' businesses. In our very first class, we talked about how creators oftentimes self-identify as the platform that they're investing the most time and energy into. Creators will actually refer to themselves as Substack writers, podcasters, Instagram influencers, OnlyFans creators. I think that's because in the creator world, the most valuable products actually become a part of users' identities. And sometimes they even invent names for themselves, like Posher for Poshmark seller, TikToker. And that melding of identity with the product is an indicator that the platform is delivering a ton of value to them. It's critical in enabling them to reach an audience, to monetize, to create something to grow their business. We can probably also think of creator products that don't rise to this level of being equivalent to someone's identity. Like I've never heard of anyone referring to themselves as a buy me a coffee creator or a Linktree creator. I think maybe those products can be useful and valuable, but they're probably never going to be as large as a product that becomes inextricable with creators' identities. There's a couple of ways to measure whether your product is delivering a lot of value. So this question is from Superhuman's product market fit framework, which surveys their customers on what percentage of them would be very disappointed if they could no longer use the product. And they found that when over 40% of the customers answer very disappointed, that means that there's strong product market fit. So companies that have less than 40% of users answering with very disappointed typically struggle to find growth, whereas companies with over 40% saying very disappointed almost always exceeded that threshold. So this is one way to tell like if your product is delivering a ton of value to its users. And during pitch meetings, I'll often probe into like, what is the value proposition that this product is offering for creators and consumers? What is the need that you're solving for? And what I'm listening for is, can the founder describe their value proposition succinctly? If they can't describe it succinctly in like one sentence, then it's probably actually not meeting any core need. And then beyond that, I'll talk about like, what's the competitive landscape? How much better is this product for these value drivers than all of the competitors that are available? And if I can name companies that the founder hasn't heard of in their competitive set, then that's also a red flag. And then I'll also think about like how many people actually have this need. So like given what the founder thinks this product is solving for, how many people out there can I actually imagine having this need? Is this a niche value proposition or is it going to appeal to many, many people? And then for those people who have this need, how much of it is a nice to have versus a must have? Recently, I attended an angel investor session with one of the partners at First Round Capital. And he had this really amazing framework, which I'm going to borrow here. So one of the ways to really drill down into like what is the value proposition of a product is to imagine and to ask the founder, like if you could have the #1 slot on Google for a particular search query, what would that query be? So if you're a founder in this room, just think to yourselves, like for your product, ideally, like what is the customer typing in to Google such that you would show up first? Like what search query would you actually own? And this question, this exercise kind of gets to, is the founder able to succinctly articulate what value they're delivering? Do they know what consumers and creators are looking for to get to their product? And can they articulate that well? So let's go through this exercise with a few different creator products. Okay, the first one is Discord. I want you guys to type into the chat, like, what is the search query that consumers would be typing into Google to ideally land upon Discord? Voice chat community, community group chat, gaming chat, chat for gamers. Yes, exactly. How I talk to my fans, that's interesting. Yes, you guys got it, precisely. So voice chat with communities is what I was gonna say. What about Anchor? Easy podcast tool. Podcast distribution, launching a podcast. Not how to keep a boat tied down, but that's a different type of anchor. How to make a podcast. Yes, exactly. So the phrase that I had been thinking was like, make a podcast without any tools. All right, what about Canva? Easy design. Free Photoshop, Photoshop alternative. I hate Photoshop. Yeah, these are really good. I love how these basically converge upon the same themes and the same ideas, and a lot of you guys are typing in the same queries. I think that means it, like the value proposition is super clear. All right, how about this one, ConvertKit? Email my fans. MailChimp, email marketing, how to grow an email list, collect emails, build an email list. Yes. Okay, so you guys got it. That is what I would say too. However, I'm not sure if that is what the company would say. I think the company, not to pick on ConvertKit, like the product does a lot now, and you can do all sorts of things with it. You can launch a paid newsletter with ConvertKit, sort of like you do on Substack. You can like sell digital products with ConvertKit. So I think ConvertKit kind of struggles from like not knowing exactly what the search query is, like not being able to have like a very distinctive value that you can think of immediately. Yeah, ConvertKit helps you find your audience, turn them into true fans, and earn a living as a creator with our audience building an email marketing software. It's quite long. I think if you can't distill it down into like 3 words, then the value proposition is too complicated for users to understand. Cool. All right, so do this exercise with your own companies and like be sure to be able to articulate that to investors. So tying this back to the creator hierarchy of needs that we had discussed in our very first workshop, we had discussed how there's basically 3 fundamental needs that all creators have, and that's to create something, then a smaller portion of those creators want to grow an audience, and then a subset of those creators want to monetize. And the most fundamental widespread need shared among all creators is this desire for self-expression and creating something. And then from there, a smaller portion wants to go up this hierarchy of needs and accomplish the other things. So if you're starting a creator business, there needs to be clarity on how your value proposition ties back to one of these 3 things. Like all of those examples that we just talked through, Discord, Anchor, ConvertKit, et cetera, like they all go back to one of these levels of creator needs. So I think you need to really be able to think through, like, am I helping creators create content? Am I helping them with their growth and engagement and building an audience? Or is it helping with monetization? And by the way, there's already tools available at all 3 levels of this creator stack. And so how is this particular startup doing something better than what is already existing? And by the way, which creator need you're focused on is going to determine the total addressable creator market size of that product. So for instance, like fewer creators care about monetization than those who care about content creation and audience building. And so that's going to impact like how many total customers you'll end up having. For instance, Patreon, which is at the bottom of this, has 200,000 total creators who are earning anything from Patreon. And that's about 8 years into the company's history, versus YouTube has 31 million total channels. So the order of magnitude that you're able to address of creators is going to differ greatly depending on which tier of this creator stack you're sitting in. And also, these 3 layers tend to give rise to different valuations of companies. So the most valuable company on this slide is, well, you guys can probably guess, like the $738 billion market cap value, like which company is that? Yes. Facebook. YouTube is not standalone. Good guess, though. I think YouTube would be a very valuable company if it was independent. It's Facebook. And then on like this, on the monetization side, the most valuable company in this tier is Patreon, which had its most recent price round done at 1.2 billion. So obviously it's still obviously a very valuable business, but the scale of business that you can build differs greatly depending on which level you are at and what type of creator needs you're solving. And that's because at this first level of the creator stack, there's really strong network effects. You're matching audiences to creators and audiences to content. So there's a really powerful 2-sided network effect. Whereas at the bottom of this creator stack, a lot of these businesses are tools and SaaS platforms that have less defensibility. Aside from the superhuman product market fit question, there are some other company-specific metrics that you can use in order to assess how much value the product is delivering to creators and users. So for instance, at Patreon, they track an internal metric called 1K creators, which is creators who are earning over $1,000 from Patreon. So if you look at 1K creators versus all Patreon creators, that kind of gets to, like how much of the user base is actually getting a ton of value from Patreon. And then if I were to be doing diligence on Patreon, I would also ask for like subscriber growth, subscriber retention. And then for every company on the slide, you can see there's like a set of metrics that you would ask for in order to assess like how much value is this actually delivering. So for HipCamp, which is a deal that I worked on a couple of years ago, it would be like hosts with bookings, GMV retention of the host cohorts, user retention, are people traveling and booking HipCamps over and over again? What is the repeat booking rate? Take rate is also a proxy for product value and lock-in. The higher of a take rate that you can charge, the more indispensable that means you are for the creator. It means that the creator can't leave you even if you're charging a really high take rate. So which company on the slide do you think charges the highest take rate? So I'm seeing lots of YouTube, OnlyFans, Instagram. Okay, it's actually Instagram. So let's see. I actually ordered this for you guys. It's in order. So the highest take rate I think is Instagram, because Instagram essentially takes 100% of all of the advertising revenue and keeps it for the company instead of paying out any cut of that to creators. Creators just don't think of it that way today, which is really great for them, great for the business, not great for creators. Versus on the opposite side of the spectrum, you have things like Buy Me a Coffee, Etsy, Patreon, which are taking pretty low take rates. And so the companies that can get away with charging a higher take rate are the ones that are more indispensable to creators. They're the ones that are helping them build an audience, which is the first step they need to take as content creators. And there's really powerful 2-sided network effects here that keep them on the platform, even if the platform might be taking quite a high take rate. Whereas on the other side of the spectrum, like Buy Me a Coffee or Patreon are essentially payments tools that they could swap out with anything else. It's not necessarily sustainable, though, to charge a very high take rate. Bill Gurley wrote a post called A Rake Too Far, suggesting that platforms charge a modest take rate, because he said that the most sustainable platform strategy was to charge a take rate that would make creators and participants feel like they got a lot of value relative to the take rate that was being charged. And Jeff Bezos said this a different way, where he said, your margin is my opportunity. So perhaps, like from that previous slide, there's an opportunity to take margins from some of the platforms that charge really high take rates. And lastly, in terms of how to measure product value, retention is also a really strong signal for how much value users and creators are getting from a product. Here are some retention benchmarks that I sourced from Lenny's newsletter that you guys can read on your own time. But basically, like Casey Winters has said, that retention is the best indicator of product market fit. So oftentimes when I am looking at a deal where there are metrics and there is traction, I'll ask for user and creator retention.
Hey, Lee, we have a relevant question from Maria Ryback.
Yeah.
Hey, Maria, could you ask your question? Make sure to unmute.
Hello, can you hear me?
Yes.
Yeah.
Okay, sorry, I had a problem with my mic. Yes, I just wanted to know if it's possible to be at 2 levels of the creator tiers. So a company that is either the first where it's offering creators the possibility to gain an audience and then also be able to monetize. What are your
Yes.
thoughts
And
on
in
that?
fact, that's more defensible. So I'm going to get into that in this section. So let me address that in a couple minutes.
Okay,
Thank you
sure,
for that
thanks.
question. Yeah. Okay, so great segue into this next section, which is the product able to grow with customers? So as we had talked about in our first workshop, creators are all at different stages of their life cycles. And the commonality is that they're all trying to up-level themselves and grow and professionalize. And so I'm thinking about, like, can this particular product or startup grow to serve creators as they're growing into adjacent markets and categories and more sophisticated needs? Okay, a quick question for you guys. What do these publications have in common? High subscription rate. Well, okay, so in case you haven't heard of these two publications, The Generalist is an online technology publication and Every is a newsletter bundle about business strategy. Okay, so Romy Lynch got it correct. The commonality that both of these publications have in common is that they both started on Substack and recently left to build their own independent platforms. So Every created its own website. I think The Generalist might be using some white labeled SaaS thing, but they both graduated from Substack. So that's really interesting, because I think the biggest risk that Substack has, in my view, is that graduation problem. They need to hold on to their creators as those creators become more successful and as they professionalize and are earning more revenue. Substack's business model, which is a 10% take rate, means that they're going to be earning most of their revenue from the most successful newsletters on the platform. And so if they're not able to retain those newsletters as they professionalize, as they add more contributors, as they have more sophisticated needs, then that is worrying for the platform. A company that has succeeded in growing with its customers would be Shopify. So Shopify has grown with its customers and built more functionality to support large merchants without subtracting from the simplicity that the long tail finds appealing. And building and growing with its customers was necessary to retain the most successful merchants. They've said, by accurately predicting how the commerce world would be changing and building for what our merchants would need next, we taught them to expect so much more from their software. So Shopify in the early days started off as a solution for the long tail of smaller merchants, solving a problem that the founders had personally experienced when trying to set up their own e-commerce store. And over time, Shopify has doubled down on upmarket merchants and gone into the enterprise and introduced Shopify Plus in 2014 to serve those enterprise merchants. And they've always framed it as a way to help customers that grow with the platform. And this is an important business line because they can charge a lot higher SaaS fees for merchants on Shopify Plus than they can in the basic tier. And if you dig into the stats, you'll see that Shopify Plus represents about 1% of their total merchant base, but it represents about 25% of their total MRR. So it's really fruitful for Shopify to retain and sell to those customers as they grow. The analogy for the creator economy is to start with a single wedge into a market, but grow with creators as they professionalize. I've referred to this as the enterprisation of consumer. So starting with a product that's easy to use, that might look like a toy and that anyone can sign up for, but grow with them and serve their needs over time as those creators start to monetize and professionalize and scale. Let's look at an example of a company that initially did not grow with creators, but is focused on changing that: Twitter. Twitter used to be used by creators for just the first 2 stages of their life cycles: creating content, tweets, and audience building. But then for monetization, those creators had to go elsewhere. They had to utilize things like Substack or Patreon or OnlyFans. Substack writers actually used to joke that Substack was Twitter's paywall. So Substack was how you monetize your Twitter presence. And when that happens, that means that Twitter is not capturing any of the value of those subscription newsletters. But now Twitter is moving to rectify that with the launch of Twitter Spaces and the acquisition review and the new super follow feature, which allows content creators to implement a monthly subscription and to offer followers things like exclusive content and community access. So this is going to enable Twitter to better retain their creators and to keep more of the value on their own platform. And then going back to my overarching investment criteria of, can this potentially be massive? Well, I'm also interested in how much value can the product actually capture. For creator products in particular, I'm interested in how valuable is this functionality as a standalone product, or would it be more valuable if it was part of a larger company? For all creator products, you're operating in adjacent spaces to large companies that are at the top of the funnel. And so those top level companies are able to potentially subsume products at the bottom of the creator stack. And so why should this particular product exist independently? Like, why is it more valuable as an independent company? And then sometimes it's also hard to capture value in the creator economy because creators have a lot of leverage and can take audiences with them, as we saw in the Substack example. So I'm always considering, like, how much value do I think will actually accrue to this level of the stack and to this particular business? And it's important that companies can capture a lot of value because the VC fund model necessitates investing in companies that can be massive. So just a quick refresher on VC fund math. Let's say someone is investing out of a $500 million fund. That's actually quite boutique these days. Most funds are larger than that. But to deliver a 3x return on the fund, that fund's holdings need to be worth $1.5 billion. And if that fund is on average owning 15% of companies at exit, that means the total valuations of those companies in the portfolio need to add up to $10 billion. That's really hard. That means that the fund needed to have invested in multiple winners. And so when you're pitching investors, this is what's going on in the back of their minds. Can this potentially be massive such that it actually can potentially return the fund? And that brings me to revenue expansion. So this is more applicable to slightly later stage companies, but I think it's useful to plant in your guys' mind ahead of time. Most creator businesses are catering to the long tail of individuals. Looking at this churn benchmark data, you can see that SMBs are a really high churn segment because SMBs don't always survive. It's a segment that has upwards of 50% yearly churn. And creators are basically like very, very small SMBs with even worse churn than this. And the best way to counteract this is to generate more revenue from successful creators than what you're losing from the churned out creators. So the holy grail of a creator business, if you're a creator business that that has some transactional element is net negative churn. Meaning that the incremental revenue from retained customers more than makes up for the revenue lost from churn customers. So for instance, if you have 105% revenue retention and 5% customer churn, what that means is that like you'll retain 95% of your customer base after a year, but will generate 5% more revenue than last year because of the growth of the retained customers. When you plot out this triangle cohort chart of GMV retention, it should look the opposite of this. Sorry, I wasn't able to find a chart that showcased the opposite of this, so I just put in this chart and said it should look the opposite. But basically, if you were to plot out your GMV retention of like by cohort, how much GMV is being driven by creators on your product in month 1, month 2, month 3, etc., like that GMV should actually be growing, because ideally the creators who stick around are expanding their usage, they're processing more transaction volume, they're growing their business, they're becoming more successful over time, combating the underlying customer churn. And there's a few products that come to mind that actually exhibit this behavior. I remember like HipCamp had this, Cameo had this, Substack had this, which basically meant like creators were investing more time and energy because they were becoming more successful over time. And you can see this kind of behavior of revenue expansion among some public companies. This is Shopify's billings by cohort. Every colored band represents a single cohort. And so as merchants become more successful, they're actually upgrading to higher tiers and driving additional revenue for Shopify. And Shopify is able to achieve this net negative churn because the business owners themselves are successful. You can also see this in Wix, the website builder company. So customers are actually upgrading to premium subscriptions over time. And as you look at each of these lines, you'll see that in the outer months, there's more premium subscribers than there were in month 1. You can also see this retention show up on the cohorted collections chart for Wix. So every color cohort band is staying pretty steady or even slightly growing over time. All right. Okay, so to summarize, these 5 criteria, which I evaluate creator economy companies through, can all be quantified. They each have their own associated metrics, with the exception of founder market fit. I'm not entirely sure how you would quantify founder market fit. I think that one's just based on feel, but the other ones can all be quantified with metrics. And so with markets that appear small but are actually big, you could do estimates, surveys to guesstimate at like what is the latent demand for something like this. For product delivering high value to target users, you could proxy that through the product market fit question, user retention engagement, CAC, percentage of organic acquisition, growth rate, cohort retention. Cohort retention would also show you whether the product is able to grow with their customers. And then lastly, the net versus gross revenue retention would be an indicator of revenue expansion. There's a lot of metrics blog posts out there that spell out how you would actually compute these things on a detailed level. I'm not going to go through each of the formulas because that's a little bit boring, but a lot of it is on the reading for this week. And then if you guys have any other questions, just feel free to DM me. And then I'll just leave you with these benchmarks for what is a good growth rate. I get asked this all the time by founders, like what growth rate are investors even looking for? So I had done some benchmarking at of the most successful companies in my portfolio and found that among those, a good growth rate would basically be doubling month over month at the very beginning for a consumer business. And then in years 2 and 3, growing 5x year over year or even higher. That is what's possible in the consumer world. And then the SaaS world has its own set of metrics for growth as well. And then lastly, here's an example of how Etsy has tried to calculate latent demand to show that the market is actually much bigger than it appears. This is from their Investor Day presentation, and the Etsy management team estimated their TAM to be at about $100 billion. And how they got there was by proxying that 40% of the population were expressives or seekers who were essentially in the market for special handmade items. And so you could think about like what percentage of the population would be interested or has the attributes that would make them a good candidate for the product that you're building. Cool. That was a lot. I'll take, maybe we can do some quick Q&A before jumping to Blake.
Yeah, we can do 2 questions. The first one, Carol Zhang, and then Maria Ryback again.
Hi, it's Carol here. Lee, I wanted to ask what made you think that the innovations and disruptions will more likely come from startups instead of the incumbents? I think I read that in one of your articles.
Yeah, well, I think Clay Christensen answers this really well in his book. But basically, like the textbook definition of disruptive innovation is like innovations that incumbents tend to underestimate because per like any sort of rational, logical analysis of the market, it seems either too small or too unprofitable to enter. And so disruptive innovations tend to be the ones that are most underestimated by incumbents, but by the time they realize their disruptive potential, it's too late.
Thank you.
Maria?
Yes. So my question is, what is your view on the difference between SaaS products and marketplaces when it comes to growth and return potential? As an investor, like if you're looking through an investor loop, what's your take on this?
So I think I don't have like any of the data points on hand, but I think the traditional view is that consumer products typically have a higher loss rate, but much like greater potential to be massive than enterprise products do. So consumer products, when they work, they can be, you know, super massive like Facebook. But like the rate of success is much lower.
Okay, thanks.
And I think we have time for one more. Travis, you want to ask your question?
Yeah. Hey, Lee. So I think this is a question that a lot of us early stage founders are wondering. Like, at what stage would you recommend that we reach out to you in particular? Because there's a lot of investors that like to kind of form a relationship and get to know you and your trajectory, versus like waiting until you have traction. How do you think about things? What would you recommend for us?
Yeah. Thinking about my own portfolio, there's definitely a number of businesses where I was the very first investor, like first check-in, they had not raised any money to date. And so that's like, you know, the earliest that I can possibly go is that. And I do that. I do that sometimes. I think you sort of have to overlay this question with the Elad Gil hierarchy of investor interest from the very beginning. It's like, what would compel an investor to be very interested without any proof points? Is it because they know you and they trust you and they've established a personal relationship with you and they just feel very confident in your ability to execute and recruit and everything like that? In which case that I think raises the possibility of investing very early on. Or, you know, if the investor doesn't have a relationship with you and is meeting you for the first time ever, then I think it's less likely that they'll be the first ever investor. But I think investors all specialize at different stages. For me personally, I'm not prescriptive. I am like very flexible on stage of investing that I do. So sometimes I'm first check, sometimes I invest in later seeds, like when there is a product and some traction. Sometimes I do Series A's. Sometimes I do like later stage companies as well. So everything.
All right. Thank you.
Yeah. Okay. Awesome. So with that, I'm gonna introduce Blake Robbins, who I think is hiding somewhere on this Zoom.
He's definitely here.
Yeah,
Okay,
I'm here.
Hey, okay, awesome. Blake, thank you so much for being here. So everyone, meet Blake. Blake Robbins is a partner at Ludlow Ventures, which is an early stage VC firm based in Detroit. Even though he's based in Detroit, He's also ubiquitous on the internet, which is how I met him on Twitter. And Blake started at Ludlow Ventures shortly after college and has had just an absolutely meteoric rise there and is now a partner. He's one of the smartest people that I know when it comes to consumer investing, future of media, gaming, esports. He's sourced investments in companies like 100 Thieves. And before his career in venture, he also did stints at SpaceX, General Assembly, and Nest before moving over to the venture world. And he's also a rising YouTube star.
Oh, no.
So thank you so much, Blake, for being here today.
No, thank you. I mean, I learned a lot from the first hour of this, so I appreciate you bringing me up to speed. I mean, I learned new things. You are far more methodical and analytical about these things than I am, and so it was interesting to hear your perspective on a lot of this.
I think creating a course is a great forcing function to be more methodical and organized and analytical. So recommend that for anyone.
Yeah, well, I'm excited to be here. So thank you.
Yeah, definitely. Okay, so I think what I'll do to structure this is first I have a few questions for you just to kick off the conversation, and then we'll also crowdsource some questions from the Slack group. So if you guys have any questions, drop them into the Slack and upvote each other's questions so I can quickly see like which questions you want me to ask. So, okay. I guess my first question for you is, I'd love for you to just do a high level overview of like what companies you've invested in the creator economy, just to level set everyone.
Yeah. So I think like the creator economy is interesting to me because I feel like I grew up on the internet in a lot of ways. Like I've been watching YouTube and Twitch, and I'm 27, so like I feel like in a lot of ways I've just, I don't know, I've watched YouTubers my entire life, or I've watched Twitch and sort of watched the rise of all this happen. And so I've always been a little bit more native to it than maybe someone else who's looked at this space, because I've sort of weirdly been a fan of a lot of these creators, and I think I just empathize with them a lot more. And I have made several different investments in the space. Like we're investors in a company called 100 Thieves, which is probably like the purest form of a creator economy bet, where it's actually almost a bet on a creator themselves, building a business around a creator. For people who aren't familiar, 100 Thieves is an esports team that was founded by a content creator named Nadeshot, who's one of the biggest, I don't know, Call of Duty players and one of the biggest gamers at the time when we invested. And Nadeshot has a huge YouTube channel of like 2.5 million subscribers and had this vision to build a bigger business around himself. And so played a big role in sort of getting that off the ground. And so we did that. And then we're investors in Stir. We're investors in a company called U2s, actually, which is this is a sort of crazy business that a lot of people aren't familiar with, but they make vinyl figures and plushies for YouTubers, and they have a really interesting business where they go to YouTube stars or big content creators and they say, hey, you already sell merch in some way, like why don't you sell vinyl figures of yourself or sell plushies? And that resonates really, really well with both the fan base and of these creators, and the creators themselves are like, oh sweet, like I'd love to have another monetization channel. And they've built a really big business off of that. Trying to think if there's any others that are like top of mind that we've bet on in this space. But the real truth is I just spend so much of my time here. Like I'm close with a lot of big content creators, and I spend a lot of my time on the big content creator side of this, like mainly out of the interest of what can you build when you have like 10 million people that watch every one of your videos. That's a question that I just think is fascinating, and I spend a lot of my time going deep on that. And so like I helped Mr. Beast launch like Finger on the App and introduce him to Mischief for that, and very, very close with his team. And yeah, I mean, that's the very high level.
Yeah, that's really helpful. So one topic that has been very popular / in vogue recently is investing into creators directly as humans. I was recently on a Clubhouse discussion with Sam Lessin where he talked about basically doing like forever ISAs with creators, where creators would have to pay back a portion of their creative income forever to him. And that would be a way for the creators to get access to some upfront capital and to be able to take like bigger bets and ideally like just focus on content creation and be excellent at that. I'm curious what you think about that versus investing in like a business that the creator is starting.
Ooh, it's a really good question. I have a lot of different thoughts about this. Like I once tweeted that I like wanted to explore creating like a YC for creators and what would that look like. And
YC to incubate creators, like the creators would come out on the end.
Yeah, exactly.
as,
Like you would
okay.
give, in my mind, you would give like $100,000 to a content creator, sort of put them through 3 months of training or mentorship, and then at the end of that, you see what happens, and you get
Yeah.
upside in some way for that.
This exists in China, by the way.
Yeah, and it was partly inspired by that. The thing that I struggle with is what we've seen so far. Is there's been like one example of this that's happened in the US with a group called Team 10, which is actually Jake Paul. And that group, he basically, when Jake Paul was first starting off, he realized that he was very big, and he was like, hey, I'm going to bring people into my content house called Team 10. And when they blow up, I'm going to get 10% or whatever percent of their upside moving forward. The problem was he made them like almost too big, if that makes sense. Like where the people that were in this house ended up having huge fan bases themselves. And like, I'm not talking like 1 million followers. I'm talking like 10 million followers. And at some point, I think you just get to this point where you're like, oh my gosh, I'm so big. Like, why am I giving any percentage to, Jake Paul or Team 10? Like, I'm just going to go public and say, hey, Jake Paul's taking 10% of my stuff. I'm leaving this group. And it just went up in flames. And I think that's just something you have to be so careful about when you're in this, I don't know, when you are taking upside in a creator or an individual. I think it gets tricky for a lot of reasons. There are so many nuances to saying, hey, I'm just going to get a percentage of your upside forever. I think it can work well in the middle case. And it definitely works well in like the, bottom case where you didn't pan out, like you probably got a bunch of money for an advance or something. But I think it will have to look, the economics would have to look closer to like a record label, in that the amount of people that actually hit and become big is small, and so a lot of these contracts naturally look more predatory, and I think that's just a really tricky nuance to explore that I don't know if I'm comfortable with it. I think it's more like, for me, I'm more excited about, and I'll say that with the caveat that like, if I could get a percentage of Mr. Beast's, income moving forward, like, yeah, that would be an amazing opportunity. But I think, Mr. Beast is now at a point where he would like be like, I don't need money. And if I did raise money, it would be for a specific project. And so I think at the earliest stages, in order for it to be like a actual economic equation and like where you can get real returns, it would be really tricky to navigate.
Yeah. I recently, I took Sam's idea of the Forever ISA and I told a creator about it. And I was like, would you do this deal? Like, what if I gave you $1 million right now? Like, what would that actually unlock for you? And how would you be more successful? And he couldn't think of what he would actually use it on. He was like, I think I would start a hedge fund and just like continue making my regular TikToks. Like capital was actually not the bottleneck for him. It was like he would take this $1 million, start a hedge fund and like invest in stocks, and that would be his income. And then he would just have fun, like continue making TikToks. So I think it's also like investing creators. I would also want to like zoom in on what is the segment of creators for whom capital is actually a bottleneck. Like what do they want to use the capital for? Because I think for a lot of creators, they don't actually feel constrained by the money unless they're wanting to use it on a specific project, as you said.
Yeah, I think, like the reason why I was even intrigued with it is because I think like Mr. Beast, if we just go back to that as an example, where he is spending a lot of money on his videos and he was reinvesting into his videos. If you buy that as like a sustainable business or a sustainable way to grow, then there might be an actual opportunity where if you gave a creator $200,000, to get started, could they actually just grow rapidly? Like, I don't know, but I think where it gets interesting is if you have like Mr. Beast co-signing and mentoring. Like, I bet you if you went to that creator, depending on what creator that was that you were talking to, if whoever the biggest creator in their industry or area of YouTube or whatever it might be of social media was willing to mentor them for a percentage of upside, I actually think they would do it.
Yeah,
Be like, I want to have access to that. I want to be able to learn from them, and I'd want to just be able
totally.
to talk to them. And so I think this whole area will play out. Like, the reason why I've been spending more time on like NFTs and crypto, and I know you're talking to Jesse next week or later this week. Jesse
Mhm.
is brilliant about this and will be able to talk about it way more than me. But I do think there is like some potential of unlock there where
Yeah.
maybe you are just buying tokens of a creator, and that's like this cleaner, less predatory way to get upside in someone,
Mhm.
and sort of staking or betting on them. I think that is what interests me more than like a pure like ISA model, I would say.
I agree. Yeah. I think like, I mean, looking at just the success that some digital artists have had with NFT sales
Yeah.
recently, like that's essentially their seed funding. Like they don't need to sign a forever ISA.
Yeah, and like the thing that I struggle with is like, there's definitely some amount of funding that you can give a creator to make it so they can like jump off and do it full time. But I think at some point they're going to need to figure out how to turn it into a sustainable business anyways. And like, I don't know if giving them 6 months or like a 6 month advance, helps them that much, or like is then the push to then make them have a sustainable career as a creator. Like, that's the thing I struggle with is like, does that actually help or not? I think it helps them jump into it full time, but I don't know if that solves like the larger pain point of like monetization is broken or whatever it might be for or like their audience growth is slowing.
Yeah. Okay, I'm going to jump to questions and people can unmute and ask their questions. So we'll start with Mika, if Mika is here.
She had to drop, so you can ask
okay.
her question.
All right, Mika's question from that she put into Slack from yesterday was, what elements do you look for before investing in creator economy companies? In particular, curious what would be different when evaluating creator economy focused companies versus any other type of company.
Ooh, I think for creator economy specifically, the thing that I'm always trying to understand is like how well or like how immersed are they in this world. And I think that like I view selling or creating products for creators as like a completely new type of small business, or like small and medium sized business. And like small and medium sized businesses are notoriously difficult to sell into, because every single small and medium sized business has their own issues or reasons and problems of what gets them excited. I think that if you don't live and breathe this space as either like a viewer or someone who's creating content or like has full just understanding of the landscape, I think it's really hard to build in this space. And so I mean, when I talk to founders in the creator economy, like YouTube's is a perfect example where these founders are just so well connected to these creators, and like I just can't even understand how they're getting some of these creators that they're working with. I'm just like, what? You know them? And they're like, yeah, of course, like we're friends. I'm like, okay, that's insane. And so like I think there is a certain level of access, and getting creators to just like use your product early on is really hard. And I think I see a lot of, or I get a lot of pitches where founders are like, we're going to build this product, we're going to have some big creator use it, and like it will just snowball from there. I think they just underestimate how difficult it is to get either that big user to pay attention or the smaller users to then pay attention after. And
Yeah.
I think that is like, you're in a lot of ways, you're building like a two-sided marketplace here for a lot of these products, and you need creators to buy in and like fully embrace what you're building, which is just hard because a lot of these creators, in my mind, for creator economy, like you need to basically, if you're building them a product for creators, you need to spoon feed them like opportunities to either like make more money or grow their audience. Like if it's not one of those two things, they're probably not going to pay attention, unfortunately, because they're just so obsessed with either like growing their audience to become bigger, or they're thinking about making more money. And it's all a trade-off in terms of how they allocate their time.
Yeah, totally. Yeah, I'm reminded as you say that about how Joe from Stir would fly down from San Francisco to LA basically every weekend when he was at the very beginning stages of starting Stir to go to all of the TikTok houses and the content creator houses and like build relationships. It was like hand-to-hand combat. He would just go to a house, like build relationships, make friends. That's what it takes because I
Yeah.
think there's no way to shortcut it.
Yeah, I mean, I have a story for Joe that is just incredible. Where Joe will probably like never talk about this in public until like this is a big business. But like, there's a pretty big TikToker that I'm friends with who called me one night and was like, I don't know why he called me, but he was like, I'm getting like scammed on my like car or something, like where he like paid for a wrap. And I was on the phone with Joe at the time, and like Joe and I were on a video chat, and Joe was like, what's the problem? Let me handle it. And Joe like went and called this like auto repair shop and like negotiated and got like the money back for this TikTok like star. And this like TikTok star is like forever grateful for Joe at this point. But like, it was a weird example of Joe just going to an insane level of just like, I want to earn their trust and respect, and I'm going to sit on the phone. And like, Joe hired like his own lawyers and like had them write like a cease and desist or something to them. It was a crazy example, but Joe like earned over this creator forever, and this creator is like incredibly loyal and willing to work with Joe on like anything. Like, this creator had no idea what Joe did or what Stir did, and was like, oh, you have a business like in the creator space? Like, what is that? And like, it ended up building a real relationship. But I think it's just an example of like, you have to really live and breathe this space. And in a lot of ways, these creators aren't going to pay attention until like you really do put yourself out there and understand their day-to-day problems. Like, that's a financial problem in a weird way that he was able to pull back into, like, hey, if you use Stir, like maybe we can give you protection on these type of things, or like help you so you're not just like paying these people over PayPal. Like these people, like, they just paid over PayPal and like had to deal with trying to get their money back. And it's just a perfect example of like living and breathing the space.
Yeah, absolutely. That's amazing. I remember that. Okay, let's go to Sergey next. Sergey Buckman. Sergey, if you're there, you're muted.
Yeah. Hey, sorry.
No worries.
Hey, Blake.
Hey.
Super cool to meet you. I love the podcast.
Thank you.
So, yeah, big fan. So my question is, we keep mentioning the big names, right? Like Mr. Beast, Eric, and all of that. And obviously, they're the celebrities. They're always going to get most of the attention. How do you view building startups that specifically target the middle class? Like the not absolutely tiny, but right there in the middle, building growth for them scalably, building monetization for them scalably, like hundreds of thousands potential creators who can grow and monetize, but will never become Mr. Beast. How do you view that?
Yeah, I think it goes back to what I mentioned before, just around like, if you are building for that, there is this opportunity in the middle class where I think it takes a lot. Like, a lot of these people are building businesses, they don't realize it. And especially in the middle class where they don't realize that they're running like businesses, I think the problem that they run into is, I don't know, let's say you have 500,000 subscribers on YouTube, which is a big number by like all definitions, but they might not like be able to reach 10 million or 20 million subscribers one day. I think you have to have like a hard look internally of being like, you know what, my content isn't the same as Mr. Beast. I'm not going to get to 20 million subscribers one day. And I think that's really hard for a lot of these creators where if their aspirations are to be, massive, then they have to be honest, like, you know what, I'm growing way slower than I thought I was, or I'm not making nearly as much money as I thought I was. That's where I think there is these opportunities to build like better monetization tools, like, community products, or, Cameo type stuff, or Pair Pop, or whatever it might be. I think that's where the additional monetization layers move in. And like Leah's talked about this, probably more than anyone, of just like, how do you monetize better off of that smaller group of fans? I think that's where the opportunity is, probably more than anything. I think it's harder to navigate, like, how to actually get those people excited, because I think a lot of them are in this like identity crisis of or maybe they're still in like, I don't know if I'm going to be a big creator. Like, I think it takes some time of your growth stagnating in order for you to be like, okay, I'm actually going to now look inwardly and focus on monetization rather than like grow at all costs. Because I think a lot of these creators are thinking about, I want to be massive. And then like eventually they're like, oh, wait, I should actually just think about monetizing on my 500,000 fans rather
Mhm.
than trying to get to 10 million.
Yeah, if I'll piggyback on that. I think a lot of the most successful creator companies out there are actually serving the creator middle class first and foremost. If you look at the YouTube breakdown of all of their channel distribution, like the vast majority, probably 99% of all of their channels would be considered middle class of creators and long tail creators. They have very little views on them. Same with Twitch. Same with Patreon. Like they're on Patreon because they can't earn enough from advertising revenue. Substack is true. That is the case for Substack as well. Like the biggest Substack email creators they have like about 100K subscribers, which in the newsletter world is actually pretty small. Like there's newsletters out there with millions of subscribers. This course platform, I think, is also created for the middle class of creators. I don't have a ton of followers, but I do have like a highly engaged follower base that wants to learn from me. So I think it goes back to what we had discussed last session with Conrad with the creator growth loop, like find a niche, activate those creators in that niche, then get them to like refer additional creators who also share their needs. So pinpointing like who exactly within the middle class of creators is this product serving? How does it serve their needs in terms of monetization or audience growth or content creation? And then finding more like them.
Exactly.
All right, let's go to Evan next. Evan Zoe.
Hello.
Hi.
Hello.
Hey, Blake. Love all your content. So my question is, are there any failed products or companies that you think could have exceeded if they avoided some sort of like critical mistakes, or maybe some of these companies or products were just a little bit too early and bad timing?
Ooh, that's a good question. I think, it's hard to say for sure, like what would or wouldn't work here. Like, I think it's interesting to look at, the full screens and the MCNs and like that world and how that might be recreated today. Like if Maker Studios was to exist today, or full screen were to, like, full screen's still a good business, but like what would an MCN look like today, and how would you think about those products? I think are interesting. I think the truth is this space is so new in a lot of ways, at least from a business side, that I think like if you ask that question 5 years from now, we're gonna get like way more interesting question or like answers to that, because I think there's gonna be a lot of businesses that are started right now with like expectations that they're gonna do incredibly well in this space, that aren't, like, they don't succeed, but they might succeed 5 years from now. Like I think there is a lot of things that are trying to be solved in today's problem, or like today's world, where the problem might not be felt as acutely. And it goes back to, I think a lot of these creators are like running businesses, they just don't realize it yet, and there's this shift that's happening right now. And so I think it's really, it's important for these businesses right now to make sure that they message correctly, and like get to the people correctly that understand that they are running a business, because otherwise it's there's going to be a lot of businesses that fail right now, in my opinion.
I'm going to extend that question and ask you a follow-up, which is, you've been in venture for a few years now, a while. What are companies that are like regrettable passes for you, that you passed for one reason or another at the time, but then you've since seen them just take off and you think like, oh, I should have invested? And what were what did you not see at the time that like you can now see apparent now to their success?
Yeah, I think this might be just a nature of, I go so deep in these spots like gaming and I don't know, creator economy, all of that stuff, that I naturally become like more jaded, or like I feel like I fly too close to the sun, that I'm just like, I've seen like 50 of these companies. Like, it's gonna be really hard for this one to break through, or why is this one gonna break through? I think Substack is probably like my biggest miss in this space, and mainly because I just underestimated like this entire movement of people wanting to move and like write on it. Like in my
Yeah.
mind, there were already so many platforms to create newsletters or blog, and I think I just underestimated how amazing the future of being able to own your audience and like them not like being like, hey, we're gonna keep that through a walled garden and you can just export that. I underestimated how easy the platform was, and I think, looking back, I should have done that deal 100 times over, and for so many reasons. But I think that's probably the one that stings the most right now. I think there's also I'm not an investor in Clubhouse, but I probably would have told you at the $100 million valuation that like I wouldn't have done that, and mainly because I just like, again, I feel like I flew like too close to the sun, that I like went through my own journey on Clubhouse where I was like, I had days where I was super obsessed with it, and then like I just completely churned. And so like I based it way too much on my own experience. And then like I just clearly had blinders. I was like, okay, like I churned, therefore like everyone else would churn. And so
Mhm.
I think it naturally just comes back to like, what biases do I have myself, and how do I account for those biases over time? And I think the best investors are like, there's investors who are amazing at reinvesting in areas where they just like already invested and that company failed. I don't know if I'm comfortable enough doing that yet. But I think like over time that will happen, where I'm like, I have a ton of conviction, or I had a ton of conviction in this space, but that company failed, but not purely because it was like the wrong product. Like it might have just been timing and founders or whatever else. And that's what I'm trying to focus on probably more than anything. But I do think it's really easy to become jaded or biased in this space when like you spend too much time. And I imagine you feel it as well, where you probably get 100 pitches of the same company or like same
Yeah.
problem that they're solving for, and you're just like, I don't know, I've seen 10 companies raise for this and they all seem to be struggling, and you're like, I don't know how this one's going to break through. And then like it will sting when that one breaks through, because he's like, what, like what happened, what did I miss?
Right.
And there's so many different factors that go into that.
Yeah. I think one for me is Cameo. We had the opportunity to do that one at basically every round and passed. And obviously that is regrettable now.
Yeah, well, Cameo is another one. We actually passed on the intro to Cameo, which like might be even worse. And so, yeah. at least you took the pitch. Is what I'm saying.
Right. It's like there's no chance. I'm not even going to meet with them.
Yes. Yeah. It was just like, what? Why would this happen? Like the only people who would do that would be like random. I don't know. It wouldn't be the high ends. And like I just
Right.
like we all immediately were like, you're not going to see the biggest stars use that, and therefore,
Which is
like,
true. You got that right.
yeah, but like we just underestimated how big everything else was, and I think like if I knew, I would hope that if I knew what I knew like now, then I wouldn't be that like jaded on that, because the thing that went back there is like it's such a clear, like it's a very valuable value prop to everyone there, where it's like you can make $100 for like 60 seconds of your time, which is just like amazing as a celebrity or creator, which is completely different than, I don't know, you see a lot of these other creator monetization tools that are like, you need to devote like 3 hours of your time to make like $100. And so, yeah, it's a good example of just like the middle class here really carrying it through, and
Yeah.
the long tail just really crushing.
Yeah, absolutely. All right. Let's take one more question. Let's go to Felipe.
Hey, what do people think about region-specific creator platforms in underserved regions, India, Latin America, Africa? The trade-off seems to be like stuff works worse there, and there's more to build. But on the other hand, there's so much to unlock. So,
yeah, I think the struggle that I have with like is really just around understanding the nuances of those markets. Like I think it's really hard to understand my assumption is that the creator pain points are similar, but it's more of just like I don't understand like all of the nuances of what other platforms might exist there. Like there might already be a Cameo and LATAM that I just don't know about, right? Like and that would be weird if like I invested and I was like, oh yeah, there's actually another one that's doing this exact same thing. I think the other piece is just like monetization in those markets is different. Like the entire dynamics of ads for creators in India is very different than it might be in the US. And so like just on a pure like ad dollar or like what you earn per 1,000 views. And I think that we're like I'm open to it. It's just I need to have conviction that the founders truly understand that market better than anyone else. Like I've spent a lot of time in gaming and esports, and there's like a huge emerging part of like Brazil in gaming and esports is like Brazil is just crushing in that world. And I spent a lot of time with teams and companies over there that are just doing incredibly well. But I still don't fully understand the nuances of those markets.
Yeah, I think it's really interesting for me right now to look at emerging market stuff too, because I think in a lot of those ecosystems, the creator economy is like a few years behind of where it is in the US today, both in terms of like the maturity of the platforms, but also in terms of like societally how acceptable it is to become a creator, how desirable it is to become a creator. So there's a lot of growth opportunities ahead, and there's a lot of I think room to like port over learnings that have worked in the US and to find those opportunities in emerging areas. So I just recently did my first deal for a company that's based in India, and the belief there, and I spent a lot of time talking to their lead investors who are based in India, is like, there's a bunch of aspiring content creators. This is becoming a more acceptable career path. There's a lot of creators who would want this thing that they're building. And like the founders understand the market so well. But I agree. I do get a little bit nervous. Like I don't fully understand the cultural nuances, the market, landscape, the competitive set, like really anything. And so oftentimes I lean on their regional lead investors to do a lot of that diligence for me.